November 2019, question number 4A. Have we gotten that question already? Kama umepata unasema yes. November 2019, question number 4A. That I only survived because of the theory questions. It doesn't matter. So long as you simply get a pass from that particular SMS number 2558. If you get a pass, we don't care whether you only manage to get the theory questions or it doesn't matter. What we want is a pass. So have we gotten that question question number 4A? So I'll start first of all with the theories of the derivatives, right? So they want us to differentiate between a currency option and a currency swap. A currency option and a currency swap. So we start with a currency option, and of course, this is your class. What is a currency option? November 2019, question number 4A. November 2019, question number 4A. What is a currency option? What is a currency option? What's a currency option? What's a currency option? What's a currency option? For sure, I know the meaning of the word option. The moment I appreciate the meaning of the word option, then straight away, right, yeah, the concept of choices, I like that. An option gives the holder the right but not an obligation of something, isn't it? Nangoja mwandike, mimi kazi yangu, my eyes are glued on the screen. The students who are asking which questions, please help me to answer them. Give them an answer, respond to them. 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 Because of the theory bit, I don't think you need my video really. Great. So tell us, ladies and gentlemen, that a currency option, I hope you'll be able to write very fast. I hope you'll be able to write very fast. That a currency option is an option that gives the holder, the right but not an obligation. That gives the holder the right but not an obligation. To buy or sell. A specific quantity of an underlying security, into bracket foreign currency, close that bracket. At a specific exchange rate, at a specific predetermined exchange rate. So, ladies and gentlemen, I hope you've been able to take that particular definition, that a currency option basically is that option that gives the holder the right but not an obligation. I'm not obliged. The right but not an obligation to buy or sell a specific quantity of an underlying security. Because of the word currency, what is this underlying security? The underlying security is a foreign currency. a foreign currency at a predetermined exchange rate. At a predetermined what year? Exchange rate. So the key words, ladies and gentlemen, is that we have in this case here the right, but not what year? Not an obligation. The right, but not an obligation. The right, but not an obligation. So when it's an option, remember somebody told us up there, when it is an option, ladies and gentlemen, there is nothing like mandatory. When it's an option, ladies and gentlemen, basically an option gives us the right, but not what year, but not an obligation, but not an obligation, not an obligation, not an obligation. So in this case here, we have the right. If we feel at that particular time of execution, if we feel that this right is beneficial to us, this option is beneficial to us, we exercise. But if we feel that we shall make losses when we exercise it, then automatically we will not exercise it, we will not go for it, right? Remember, we have got generally two types of options. Is there anybody who is able to remember these types of options? We have what we call the put option, and what here somebody? Call option. Put option, stroke call what here? Call option. So the put, you're putting, ladies and gentlemen. So in this case here, put option gives you the right, but not an obligation to sell. It gives you the right, but not an obligation to sell. And a call option gives you the right, but not an obligation to do what you're to buy. Gives you the right, but not an obligation to buy. So most importantly is for us to really appreciate up there where we said that a currency option gives the holder the right, but not an obligation to buy or sell. That is a currency option. But now down here, we are able to really narrow this down into two types of options. Put gives you the right to sell. Call gives you the right to do what you're to buy, like that. And then, ladies and gentlemen, on the same line, they want us to define the currency swap. They want us to define the currency swap. Is there anybody who can help us define this currency swap? I'm giving you a minute. Is there anybody who can help us define this currency swap? I'm giving you a minute. A swap. What's a swap? What's a swap? What's a currency swap? To exchange, to switch currencies, where two organizations contractually agree, right? So mention there that under a currency swap is a formal agreement, whereby two organizations contractually agree to exchange payments, on different terms, on different terms, e.g. in different currencies, Ladies and gentlemen, for me to be able to simplify this, they are talking about currency swap. So we'll have two organizations here. We have company A, company B. Company A could be based in the US. Company B could be based in Kenya. Now, company A, ladies and gentlemen, for example, could be wanting to invest in Kenya. And perhaps in this case here, these guys here want what here? 100 million. They want 100 million Kenya shillings. But remember, they are based where? They are based in the US. And then B company, which is in Kenya, may be wanting, in this case here, ladies and gentlemen, a loan of, say, $1 million US dollars. So in this case here, of course, I've chosen to work with 100 million and 1 million because I know averagely, on average, of course, I know that it's quite at a lower level, but averagely, we can talk of $1 being equal to 100 Kenya shillings. 100 is the base, is our base. You can see in this case that these amounts are quite what here, almost the same. So, you know, it will be very easy for a company that is based in Kenya to access these 100 million Kenya shillings in the form of a loan. It will be able to go, for example, to Equity Bank home here, and they structure a very good arrangement. They are known here in Kenya. And at the same time, it will be easier for a company that is in the US, in this case here, to borrow what here, this money in form of US dollar. So then what will happen is that, given that this, of course, you are aware that the two companies cannot just start transacting like that, the two companies must be in a relationship. The two companies must be in, for example, a parent-subsidiary relationship. They must be knowing each other, right? So in this case here, what they will do, A will be asked by B to borrow this in US dollars because they are in the US. And the A will ask B to borrow, in this case here, this in Kenya shillings, because of course it's in Kenya. And then what will they do? They will exchange the obligation. They'll exchange the obligation. So basically they are going for this swap because of the preferable, right, interest rates that they'll be able to get when they borrow in their local markets, after they've been able to tap onto these advantages of borrowing in their local markets. Then what do? They swap. Hey, you wanted to invest in Kenya. You wanted 100 million Kenya shillings. This is your money. Now you can use it the way you want. But of course, they know that they're basically exchanging obligation. So whenever we talk of currency swaps, we are exchanging obligations. From there, Roman ladies and gentlemen, they want us to differentiate between an interest rate swap. Same concept. Interest rate swap vis-a-vis interest rate collar. Interest rate swap vis-a-vis interest rate what here? Collar. So again, we have company A, we have company B. So company A, ladies and gentlemen, in this case here could be having a loan of say 10% fixed. It's a fixed loan, 10% per annum fixed loan. And then B could also be having 10%. In this case here, a floating loan. This is a fixed loan of say 10 million Kenya shillings, and also this one here is 10 million Kenya shillings. Now, ladies and gentlemen, remember that always grass is greener on which side? On the other side. Grass has never been greener in your area, but unless you really know how to water your own grass. Grass will always be better on the other side. That is why most of us in this case here are really dreaming of getting jobs at the UN, But if you go to the UN today, you will still get so many people working there who are still doing applications to other companies out there, other organizations out there, because they are dissatisfied there. Because according to them, their grass there is not greener. So the same case, you will get this company where they are. When it's fixed interest, it means what? It will be 10% of 10 million, which is $1 million every year interest, every year. So you will get this guy saying, we wish we knew, would have taken a floating interest rate. A floating interest rate means what here? That when the interest rate in this case here changes in a particular market, of course, if it increases, then automatically the banks increase your rate of interest automatically, right? Like right now, people who are on a fixed loan, companies that took a fixed loan interest, they are really smiling to the bank. Because after that cap of 14% was lifted, we now have, in this case here, very many banks, in this case here, which have taken the interest rate so high. That is why this year, there is no bank, even a family bank, there is no bank that has posted a loss. All banks are posting supernormal profits because already they are now overcharging their clients. So if there is any company that has taken, ladies and gentlemen, a fixed interest rate, then this company automatically is now enjoying. But now that is not the point for this. The point is here. So you'll get a company saying, we wish we knew. We would have taken a floating loan interest, a floating interest loan. And then B on the other side is also admiring a company in this case here that may have decided to take a fixed loan. So then what will happen? Of course, these guys here will always go to their bankers and tell their bankers, hey, is there a possibility of us changing our obligations, of us changing from fixed to floating? Another person goes to the same banker, hey, can we be able to change from floating to fixed? And then now what will happen, because the amounts are the same, this banker will call these two, for instance, gentlemen to some table, tell these gentlemen that, hey, I've had both of you in this case here speaking like you would want to change your loan obligations. Your loan obligations. Now, because that has happened, that I've overheard each of you speaking separately in different platforms on your preference to exchange. Now that I have both of you here on the table, can you swap? Can you exchange? So when we talk of interest rate swap, here now we are swapping, we are exchanging our loan obligations, which are denominated, or rather which have different rates of interest or different loan obligation stroke commitments. For us to be able to capture that very well, mention there that interest rate swap is a type of a derivative contract. Is a type of a derivative contract. Is a type of a derivative contract. A type of a derivative contract. A type of a derivative contract through which two counterparties, through which two counterparties agree to exchange one stream of future interest payments, for another, full stop. In most cases, interest rate swap, includes exchange of a fixed interest rate for a floating rate. Ukiulizwa tataki Kiswahili mingi, ukiulizwa what is an interest rate swap, we are swapping loan obligations between two counterparties. Basically, one counterparty is giving up his fixed interest rate loan for a floating interest rate loan. And of course, vice versa. The other one is also accepting etc. So can I go, ladies and gentlemen, to interest rate caller? Can I go to interest rate caller? Andika Y for yes. Can I go to interest rate caller? Unaandika juju in a language that you will be able to really understand. Now, the caller, ladies and gentlemen, of course, is this one here. The caller, of course, is in between what here my head, which in this case here is the maximum, right, rate, and of course my body, which is what here minimum. So when you talk of interest rate caller, we must be having a range beyond which we can never accept to move. A range be out of which we can never accept to operate. So we have minimum and maximum rate of interest. For us to understand that, tell us that an interest rate caller is an instrument, that combines both a cup, and a flow, that combines both a cup and a flow. The cup component, yani kofia. The cup component gives the investor protection against rising interest rates by guaranteeing that an investor will never pay above a pre-agreed rate. This is the cap above. Remember, it's a collar. So collar hapa juu kuna cap na chini kuna flow. Right. Abracadabra, mimi nataka kuvuta hii, naweza kuandika kuhusu flow. Naweza kuvuta hii haraka, naweza kuvuta haraka. Unasema yes, haraka. After all, you guys will be able even to share these notes kwa group. Yes. So after full stop there, move on and tell us there that the flow component of a collar, allows the investor to take advantage of the falling interest rate. Ayo inatosha wewe. So long as umesikia kidogo, usitoke bure. So basically here, the investor will be told, in this case here, your level of operation is between here. If, for example, central bank's interest rate exceeds this, us will be able to cushion you from any excess, right? And for us, of course, when you are lending money to us, whenever you're lending money to us, also, should these rates here go below this, of course, there is no way we'll be able to. So you are cushioned either way. You have a minimum, you've got what here, a maximum. And then we have Roman 3, difference between hedgers and speculators. So one word, is there somebody who can give us one word that defines a hedger? One word that defines a hedger, or two words? Who is a hedger? Who is a speculator? Who is a hedger? Who is a speculator? A hedger, of course, in this case here, to hedge is to fence. To hedge, in this case here, ladies and gentlemen, is to reduce your risk protection years. So a hedger would always go for risk minimization. How about a speculator? What does a speculator go for? Profit maximization. Thank you very much, Zamzam. Profit maximization, yes. Profit maximization. So basically, speculators buy and sell derivatives to make a profit. They buy and sell derivatives to make a profit. And the hedgers buy and sell derivatives to reduce risk. Hiyo si imekutosha ama unataka tena tuendelee kuexplain? Hiyo si imekutosha ama unataka tuendelee kuexplain tena? Tuna-explain nini? Ukisikia tu hedging, you are reducing what here? Risk minimization. Kama speculators wa shamba. Speculator wa shamba hawataka kujua mambo, ana buy leo 10 years aende kufanya namna gani? Kuuza, apate nini? Apate profit. So what have we said? We've said that a hedger buys sells derivatives to minimize what? To minimize risk. And the speculators, they buy sell derivatives to maximize. Them they're after profit. The speculators is profit motive. To maximize what? Profits. To maximize profits. Okay, so I hope that is okay. The other thing that I would want you guys to look at, I would want you to look at November 2016, question number 5. 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 Is there anybody who is able to see that question? Anyone who is able to see the question? It's only one student. Wanauliza shortcomings of the Black-Scholes model. Shortcomings of the Black-Scholes model. Shortcomings of Black-Scholes model. Shortcomings of Black-Scholes model. Iko mwanafunzi anaweza kumbusha mwalimu haraka 5A, yes. Iko mwanafunzi anaweza kumbusha mwalimu haraka hizo shortcomings. Oye, shortcomings ni sawa na disadvantages. Shortcomings ni sawa na assumptions. Shortcoming ni sawa na assumptions. Nangoja kusikia kutoka kwenu. Mimi nangoja kusikia kutoka kwenu. Ladies and gentlemen, this model assumes that so many things are what here are constant. If you can remember, Black-Scholes is this model where you are supposed to get D1, D2, VC, VP. That model of D1, if you remember D1 equals. So it makes so many assumptions. Number one, it assumes in this case here that it assumes that all options have a fixed maturity period. I.e., ladies and gentlemen, it assumes that all options are European. All options are European. It assumes that all options are what here? European. Hata mnajisumbua tu bure. Ningekuwa nyinyi singekuwa hata najishughulisha hata ni sitting gani. Unaandika kama mimi hapa, shortcomings of Black-Scholes model. Unaandika shortcomings of Black-Scholes model, hata unaacha kuangalia vitu mingi kwa past paper. It's a theory, so long as you capture the title. So ladies and gentlemen, we are saying that options here have a fixed maturity. If you remember the D1, kuna mahali kuna T. Kuna mahali kuna T. So it assumes that all options in this case here will mature after a definite period. Meaning that it assumes that all options are what here are European. Remember, in terms of maturity period, we've got two types of, actually three types of options, if you remember. Tuko na European options, tuko na American options, tuko na Bermudan options. Mnazikumbuka kweli? European options, tuko na American options, tuko na Bermudan options. Mnazikumbuka? Jesse amesema yes. Yes. So remember, European options, you can only exercise them upon maturity. They have a maturity period. American, you know, American people are the best, right? Hawana mambo mengi. You know, wanasema hawezi kupangwa, isn't it? Right? You can exercise an American option anytime before maturity. And of course, American options, ladies and gentlemen, because of that property, we cannot use this Black-Scholes model to really evaluate them. Yes. So number two, the other assumption that you guys are supposed to remember very fast here is that this Black-Scholes model assumes that the rate of interest, it assumes that the rate of interest is known in advance, and will remain constant, It assumes that the rate of interest is known in advance and will remain constant, Of course, there is an R somewhere. We know that in practice, rates of interests have never remained constant. These are shortcoming. It's an assumption. It's a disadvantage, right? Ladies and gentlemen, it assumes that straight away that these option owners, are only after what we call the capital gains. That the option owners do not have any desire of dividends in between. All of them will keep on, in this case here, selling these options here from one counterparty to another counterparty, because they're only looking at what here, the capital gain. So it makes an assumption that there are no dividends being paid at the middle here, which is very wrong. Who will go for an asset? Yes, Roba amesema vizuri kwamba volatility will remain constant. Volatility, the standard deviation, the standard deviation is known in advance and will remain constant. How can it remain constant? And the keyword here is volatility. That's a big shortcoming. It's a big shortcoming. Remember, it also assumes that these capital gains, the returns, are normally distributed. They cluster around some mean. They cluster around what here? Around some mean, which may not be practical. Hizo zimekutosha, si ni kweli? Hizo zimekutosha. The other question ambao unaweza ukapata wanakuuliza haraka kulete marks mingi sana, ni ile ya differences between futures and forwards. Hiyo si unajua sana. Iko mimi niliambia ati forward ati ni gari za Kayole oye, ati ndio zinaitwa forwards. Difference between futures and the forwards. Could you kindly help me? Kindly help me very fast. Differences between futures Yes, differences between future. Yeah. And the participants have hit 100. I need to increase. There must be people who are really suffering out there. There must be people who are really suffering out there. Tutaenda break kidogo, lakini kabla tuende break kidogo, unaweza kununua ile Zoom ya more than 100. We need to buy that Zoom ya more than 100. Tununue ya 500 because I'm so sure this week nitapata wanafunzi wengi. Bado niko free. Nitapata wanafunzi 300. Nikubaya, mtihani imekaribia So amjaniambia bado differences between futures and the forwards. See, namna hiyo, only 3 differences. Only 3 differences between futures and the forwards. Only 3 differences. Only 3 differences. How are we buying this thing? I wish I could buy as we continue. Because unaweza kudisconnect class, unaweza kuanza kuleta mambo mengine ilete shida. Wanasema namna hii, MDJC alikataa kuniambia kama ni msichana ama ni mvulana. Akiwa aliniambia mwalimu usiulize hivyo, it doesn't matter, but it's good for me to know. Wanasema namna hii kwamba futures are dollar denominated. These ones, the forwards, kama zile magari za Kayole woye, ni aina yote. Ni other currencies. Wana kustua kwa barabara wa jamani, hatari sana. Hawa ni hatari. Yes. Na ngoja muweze kuniambia number 2. Jesse anasema futures, in this case here, remember futures normally trade in organized markets. Hizi futures was that trade in organized market. Zilianza kitambo sana kule America in organized. Kuna market ya hii. Hizi as they develop bado. Hizi ni bure tu, hata hakuna contract. Hizi nakuanga ni over the counter, OTC, over the counter. And because of that, nimeona some lady hapo anasema mzuri sana. Anasema kwamba hii future, because they are traded in organized markets, hizi futures straight away zinakuwa na lower risk vis-a-vis what ya somebody, inakuwa ni high risk sababu ni over the counter na parties involved. Hata government ijuangi sana hii maneno. Mambo ikiharibika, one counterparty akashindwa kulipa, one party akashindwa kulipa, inakuwa international disaster. High risk. Fatma anasema futures are standardized. Huyo Fatma ni hatari sana. Anasema futures are huyo anajua sana maneno. They are standardized. Hizi zingine hizi zinakaa ambaye hizi gari za Kayole ni non-standard. Yani futures ni kama ile dollar, not even dollar, hata noti ya 1000 ni standard. 1000. Lakini ingine sababu ni over the counter, you can even have somebody or other 2 parties drawing contracts over forwards of even 1 million and 2 shillings. etc. Thank you very much. You guys have given me more points in this case than I even expected. Lakini sababu hatufanyi PhD, situachi hapo jameni. Sio imetosha jameni. Imetosha ama haijatosha? Imetosha, si ni kweli? Hapo imetosha, asante sana. Asante sana. Now, ladies and gentlemen, that takes me to November 2019, question number 3A, where they asked us to give them functions over IMF, functions of the International Monetary Fund, functions of the International Monetary Fund. Unaweza ama uwezane nayo. Functions of the International Monetary Fund. Functions of the International Monetary Fund. International Monetary Fund. International Monetary Fund. Very good. Gilbert anajua sana. Advisory role. Advisory role. Kama saizi wanafanya sana. Hii mambo ya COVID. Yeah, advisory role, that is very important. Facilitation of international trade. I love that. Facilitation of international trade. Facilitation of international trade. International trade, simply because they would want to correct what we call negative balance of payment. Facilitation. Promote exchange stability. I will take that one, Robert. Promotes exchange stability. Promotes exchange stability. Like right now, they are very happy, given that the Kenya shilling is really losing value. They are very happy because, according to them, they are saying that Kenya shilling is even more weak. It's the government which is trying to protect it. If the government was to leave Kenya shilling onto some open market, there will be a free downfall of the Kenya shilling. They are projecting that $1 should be about 130 Kenya shillings, which will be very, very bad for an importing country. Net importer. Nyambura anasema some people are locked outside because of the 100. We shall overcome. Waambie wangoje video, tusimami, waambie wangoje video, but next time please, nikimaliza tu namna hii at 9:30, nikimaliza namna hii, next time ta make sure kwamba nime increase capacity. Poleni sana. Waambie wangoje video, tena wasikasirike. Sasa si wakati wa kukasirika. Ukasirika unajaribia mambo mengi sana. Kama hii Zamzama anasema elimination of balance of payment disequilibrium, you can take it also as a separate point. They also give, in this case here, yes, loans to member countries. Although this is never a major objective of what your IMF, how to exchange rate stability, promotion of what here, international trade, advisory role. Kabla kupatie hii, wanakuambia kwamba they are our advisors who have to look at, yes. Now, how about, ladies and gentlemen, promotion of investments? I love that. I love promotion of investments. How about roles of World Bank? Roles of World Bank. Uwe ukigoogle haraka. Roles of World Bank ni gani? Patapotea. Roles of, same as IMF. Hapana, asante. Lazima unaanza na advisory. Advisory na apply kwa zote. Advisory, giving in this case here, member countries, development loans. Nimeona mnasema kuhusu guarantor. It comes in as a guarantor whenever two nations, technical services to member countries, ndio sawa na advisory. Technical services to member countries, yes. For economic and social development, yes. Great. And I'm so sure that all of us really would have gotten all the marks there. All of us would have gotten all the marks there. Kuna kaswali waliwaletea ka transfer pricing. Ka May 2018, question number 5. May 2018, question number 5. May 2018, question number 5, boy. May 2018, question number 5, boy. Objectives of transfer pricing. Objectives of transfer pricing. Objectives of transfer pricing. Objectives of transfer pricing. So objectives of transfer pricing. Kumbukeni, ladies and gentlemen, a transfer price basically is that price that you charge for what we call internal goods. Goods in this case here that are being transferred between departments, between related entities. The price we charge for these goods in related transfer pricing. Now, ladies and gentlemen, what is the key? What are the key objectives of transfer pricing? Number one, of course, we have the concept of what here? Performance appraisal. Meshaandika namna hiyo. Meshaandika performance appraisal. Tuko pamoja kweli. Performance appraisal. Thank you very much. Performance appraisal. Why is this a very important point katika transfer pricing? It's because of what here, ladies and gentlemen, transfer price is able to change all these departments to profit centers. Remember, profit equals revenue minus cost. Initially, this what we used to call landlocked. The landlocked departments. These are landlocked department that does not have access to external customers. Haikuanga na mbeshashi yake. Haikuanga na revenue yake. But now, because of transfer pricing, now we have revenue for this department, and as such, it becomes what here? A profit center as well. Kama hii kona revenue yake, kona cost yake. Now, why did we introduce this concept of transfer pricing? Remember, when we go to the AGM, the shareholders do not want to hear how good you are in terms of minimizing your cost. That is nonsense to them. Then what they want to hear is what profits were you able to drive in the year, because they know that it is out of profits that they shall be able to get their dividends, right? So then they wanted to have a way that every customer, or rather every department of this organization here, regardless of whether it has got its own external customers or not, they wanted a way that each department was to be changed to become a profit center. And they found out, ladies and gentlemen, that to be able to do that, then this thing of us transferring goods to our sister departments for free is hogwash, is nonsense. We have to transfer these goods to our sister departments at a fees, so that we change all these departments to what we call profit entities. When they are profit entities, it becomes easy for us to be able to appraise their performance using a common denominator, which is profit, which is basically a metric loved by the investors. So I love that. That's number one. Number two, somebody has spoken about what is divisional autonomy. Divisional autonomy. So we want these two divisions here to be what here? Autonomous. If I feel that unanifinya na hii transfer price yako sana, umecharge expensive, remember, if I'm an autonomous independent division, then I can decide to even buy those goods from out there. If, for example, A is able to get a customer out there who is able to give them a better price than what B is giving it, then A is at liberty, it's independent. Ladies and gentlemen, number three, we have the concept of goal congruence. Goal congruence. You know, goal congruence means what? Goal agreement. Remember, the major goal of the company is to maximize profit. So when you charge transfer price, and then automatically the departments now are also able to talk of profits throughout, then we are having divisional goals being the same as what here? Organizational goals. What we call goal congruence. Right? Please have seen somebody use a tax evasion, right? That's not a very good terminology. No. We talk of minimization of global what here? Taxes. Minimization of global taxes. Number four, we have here minimization of global taxes, or you'll get some books calling what here, the concept of shifting profits to tax havens. You shift profits to tax havens or havens. Like the Pandora box, right? And really there is no problem with that. It's not illegal, right? It's not illegal at all. So long, you know, even these big multinational companies, talk of ABSA, talk of EABL, all these big companies, ladies and gentlemen, they have their headquarters in Cayman Islands. You'll be surprised. Yeah, they just have an office there, which they'll call a management office. An office in this case that manages all their subsidiaries in the world. Why? Because we would want, in this case, that management office there to charge us management fees. And they charge us a heavy management fee. So we transfer money to Cayman Island simply because Cayman Island, being a tax haven, their taxes are almost zero. When money goes there, automatically we shall be paying for this money as an invoice. So we transfer money there. There are no taxes there. So these guys now can go to Cayman Islands anytime and, of course, do whatever they are doing there. And when they are coming now back to Kenya, they'll be saying that we did businesses out there, we made money. So now they're repatriating their money. Ladies and gentlemen, transfer pricing also comes in very importantly for finance in terms of what we call dividend repatriation. Dividend repatriation from enemy countries. Dividend repatriation from enemy countries. Nakwambia kuna country. Like I remember there is something small that I did, Bujumbura huko ni Burundi. Nakwambia kutoa pesa Burundi kuleta Kenya. Ni kazi ngumu sana. Right? Kuna watu ambao wana protect sana pesa zao. Hata saizi Mayoma, ukiuliza Mayoma atakwambia Southern Sudan. Hawezi ukatoa pesa Southern Sudan. Utoe Southern Sudanese pound. Utoe hivi ulete Kenya rahisi. Mayoma, is it easy? Kitambo, when it used to have value, people really used to move with this money across borders. Actually, it's only Kenya and maybe America where people have got very liberal policies on their currencies. Many countries are always talking about pesa zao rahisi hivyo. So the only way out is, for example, if I want to get some Southern Sudanese pounds from my home's country, is Mwalimu here will write an invoice to my home saying that I've done something for my home, so I'll be able to repatriate some money to Kenya, right? Yes, avoiding these import quotas and import quota restrictions, etc. I'm so sure now with this explanation, you guys will be able to pick up something and really run with the ball. You run with the ball. Unajua mwingine hata ukimpatia ball ambayo ni rahisi kucheza, ball soft, yeye hatawezi kimbia na ball. Anashikangwa nayo hapo tu. Mwingine anashuka na muscle pull, kazi na binamshika hapo, anaanguka chini na mara moja. Great. November 2017, question number 2, boy. November 2017, question number 2, boy. Eurobond and the Euro notes. Eurobond and the Euro notes. Difference between Eurobond and the Euro notes. Eurobond and the Euro notes. Eurobond, Euro notes. Alafu please nataka kuwaonya. Swali yoyote ya CASNEB, ya theory, usikose kuandika. Hata kama uelewi chochote, kama hapa I'm so sure so many guys who are writing about Europe, even giving examples of European water countries, even European football clubs, which is very much recommended, right? Always ensure that you write. Andika. Kizungu unaandika paka unatumia Kizungu unasema however, nevertheless, moreover. Unaongeza. Because at the end of the day, trust you me, most of these theory questions, we end up, ladies and gentlemen, giving marks for free, so long as you've written something. Na hii theory itawasaidia sana hata ukiona kwa class ambayo utafanya kesho ya advanced FR. Itakuwa ni theories peke yake, because unajua theories zimesaidia wanafunzi sana. Theories zinasaidia wanafunzi sana. In this regard, thank you very much. Wewe unajua kwa very good. Ukiomba script extra, that is very important, yes. That is very important, yes. Yes. Right? Yes. Sasa niambieni, what is a euro bond? To facilitate loans, I like that. Basically, a euro bond is a long term. This is a long term international loan. International loan. A long term international loan, i.e. a loan denominated in foreign currency. In foreign currency. In foreign currencies. Yani ukisikia amekuambia euro yen, this is of course a loan that has been borrowed by a poor country like Kenya, which is denominated in form of what here? Yens. Euro has got nothing to do with Europe. Euro means foreign. Kama Kenya tumefanya hizi euro bonds, sasa tumeenda mara ngapi? Ya 6 euro bond. Hiyo pesa haionekani. Kwa siku mheshimiwa Raila Odinga alikuwa anasema pesa kama 200 billion ikiingia kwa country, hiyo paka hata utasikia ikinuka. Utasikia harufu yake. Sasa imekuja mara ngapi? 6. Na harufu hatusikii, hatujui. Great. 200 billion. So, nakumbuka Kenya, huwa tunaomba kutoka countries gani? Britain, Germany and US. Hiyo ndio brakadabra. Ya hata China, tunaomba sana. Now, how about euro notes? Euro notes. Ni kama commercial paper. Thank you very much, Fatma. Ni short term. So these of course are short term, lakini international because of the word loans. International loans. i.e. loans in this case here, of course, are short-term loans. Short-term loans are denominated in foreign currencies. This is my country kama kina Kenya zinanga aibu. Utapata zinakimbia kuenda kuomba euro note hata ya miezi 3. Hazina aibu. Kama Uganda uliona international airport yao inaenda, hakuna aibu, right? So you euro note. We shall overcome. Now, Roman 2. Walisema an option in the market, in the money option, and out of money option, and out of money option. In money options, and out of money options. Yes. Kichwa ngumu kabisa. In money options. And then we have out of money options. In money options. Very good. Win ni amepata. Hata kuna hata ja kuongea sana. Ladies and gentlemen, in money options, are options that are profitable. Options that are profitable. Profitable options. Profitable options. If you exercise them today, you will make a profit. If you exercise them today, you'll make a profit. And then out of money options are, of course, loss-making. Loss-making options. And therefore, they are never what here exercisable. You can't exercise them. Remember, an option, you have an alternative. If I feel I'll make a loss, like this one here, then I'll not exercise. Alafu nakumbuka kuna ile ambayo tunaita at the money. Kuna ile tunaita at the money. At the money options, these are those options in this case that are what here able to break even. That are able to break even. That are able to break even. At the money. At the money, they're able to do what here? They're able to break even. They are able to break even. At the money. Mimi najua umeshaelewa zaidi. Great. Haya. Sasa tunaendelea vizuri sana. Hii revision kit yangu ni mzee sana. Ulikuwa unauliza page gani? Ilikuwa ngumu kuambia ni page gani. November 2018. Tuangalie November 2019 kwanza. November 2019, question number 1A. Asante sana P. Mwangi. Wanasema hiyo tayari 20 marks. Sela anauliza hizi zinaweza kuja kweli? Hata mimi sijui. November 2019, question number 1A. Question number 1A. Are we there? Distinguish between insolvency and bankruptcy. Distinguish between insolvency and bankruptcy. Ngoja mniambie haraka. Insolvency and bankruptcy. What do we have there? Insolvency and bankruptcy. What is the difference between the two? Just squeeze unaonanga watu wengine hata wajui maana ya bankruptcy. Akiona watu wa madeni wamemsumbua kidogo anda kotini declaring himself bankrupt. Ladies and gentlemen, the most important thing that you're supposed to know is that both terms are quite related. However, bankruptcy occurs when a firm's liabilities exceed the market value of its assets. So bankruptcy, we have, ladies and gentlemen, total liabilities being more than total assets. In bankruptcy. And then, of course, insolvency, ladies and gentlemen, this has got every characteristic of you being illiquid. You don't have money totally, right? Insolvency, you don't have money totally. So under insolvency, a firm is unable to pay its liabilities as they fall due. A firm is unable to pay its liabilities as they fall due. So in short, under insolvency, you don't have money. You don't have money. That is the asset. You could be insolvent, but you still have huge chunks of land around, right? So under insolvency, basically, you don't have what? Yeah, money. And you see, at the end of the day, who is going to make these decisions here? At the end of the day, bankruptcy, insolvency, they will find themselves. You'll find yourselves where in court. Because if, for example, your liabilities are more than your assets, when these creditors come, at the end of the day, you will not be able to pay them. So then what do? You'll be taken to court. Either you are taken to court or you take yourself. You know, there is what we call voluntary bankruptcy. You take yourself to court and say, hey, here I am. My creditors want to kill me. So in this case here, please protect me. And the court will be able to protect you, right? But now the question is, as the court protects you, is bankruptcy a good thing? Is bankruptcy a good thing? Is bankruptcy a good thing? No. Remember, when you are bankrupt, number one, you are never allowed here to walk with more than 200 Kenya shillings in your pocket. That's the maximum you should be having. Any excess money you have more than 200, out there, people can easily take it from you without you having any recourse. 200 maximum. Once you're declared bankrupt as an individual, even your madam, if you're a man, is allowed to divorce you, because a bankrupt person should not, you know, you are a nuisance. When you're bankrupt, you are a nuisance. It's international what it is a disaster. It's international disaster, yes. It's international disaster. Great. So there we are, ladies and gentlemen. Let's pick up from there tomorrow. Remember, every day it will be AFM for 1.5 hours. 1.5 hours or 1 hour, 15 minutes every day. Paka tufanye mtihani. Haya, alafu kuna ningeacha kurecord.